Welcome to Golden Record, an S&P Market Intelligence podcast where we discuss challenges, solutions, and hot topics in the world of corporate actions. I'm your host, Amanda Burgess, from the Managed Corporate Actions business within S&P Global Market Intelligence. In today's episode titled, It's a Taxing Business, I'm joined by Brian Galm, Director of Financial Reporting at SEI, and Chris Liguori, Executive Director of Tax Services at S&P Global Market Intelligence. We discuss taxation across corporate action events and asset classes and the impact of new tax regulations on the industry. Thank you, Brian and Chris, for joining me today.
No problem. Thank you for having me.
So, as you know, we want to talk about tax and how the upcoming new and revised regulations are impacting the industry and corporate actions. But first, could we spend a couple of minutes talking about why tax is such a critical component for corporate actions, kind of a crash course in corporate actions tax, so to speak? Brian, can you break it down for us?
Sure. Well, to start, the tax determination will actually dictate how we process the corporate action. So what I mean is, let's go to one topic that's also a confusing one, which is a taxable spinoff. You know, when you think of a spinoff, you think of two companies or one company spinning off into two. Well, with a taxable spinoff, that's not necessarily the case. The company could be holding shares of another company and then want to divest by distributing those to shareholders. So you need to figure out, all right, is this taxable or is it not taxable? Because if it is taxable, basically we have to book a phantom income and then use that income to buy the new shares. If it's a non-taxable distribution, you then allocate cost from your original holding to the new shares. So as you can see, there's a big difference because no one wants to pay taxes on income that, one, they didn't receive, and two, shouldn't have in the first place, right?
Right. And I guess that's the big thing to remember with corporate actions is just because there's no cash involved doesn't mean that there's no tax event happening.
That's exactly it. And then people are wondering, all right, well, then why do you book the phantom income? Well, you have to book the income because you need something to purchase the shares that's not actually going to debit the account, because your shares need to be brought on with a cost basis, which would be the purchase price. So if you don't book that actual income first, you'll be debiting your actual account money, which can overdraw accounts. It has other ramifications that just aren't good, and you're going to get some angry phone calls.
Yeah, especially if they're subject to withholding, in which case you have to make sure you also sell enough shares to manage whatever withholding needs to happen on the client accounts.
Which actually, that's a good point. Actually, a few weeks ago, I got brought into something where it was a taxable dividend. The team booked a gross dividend with a reinvest. However, what they should have done was book the net income and then reinvest at the net rate. They didn't account for withholding, so therefore the account was overvalued due to the additional shares, let's say of 20% more shares, because it was a 20% withholding.
So, talk to me about some of the challenges firms are facing when they're determining the proper taxability. What makes it tricky sometimes to identify? You mentioned a spinoff, for instance, like how would you know whether or not that is, or what are some challenges that come along with that?
Well, luckily there are some good vendors out there that do it for you. However, I'd say the more tricky ones are some of the foreign countries that aren't as transparent or have documents on their websites um, as readily available to see if there is. So here, for a U.S. company, they'd have an 8937 out there that could say, hey, we believe that it should be treated as a non-taxable event, and therefore cost should be moved from your original holdings. A lot of the bigger companies will actually have that on their site. Or when they are, some of the bigger companies, and especially the U.S., will actually keep the taxability of it in mind when trying to structure the merger or the spinoff or the distribution.
Mhm.
Yeah,
And
if you're lucky, you'll get guidance from the company in most cases as to what the treatment
yeah,
should be.
if you're lucky. And then
If
if you try reaching out to them, which I've had in the past, they actually say, "Oh, you should contact your local tax advisor." Like, Believe
Yeah.
it or not, I'm contacting you because you guys structured the deal. Um,
And one thing to remember there is that even when you do get advice, it's general advice that applies to most people. The reason they tell you to consult with your tax advisor is your particular situation could be different. And so you
yeah,
really should
so
look at it. That's what
I would
Brian
agree.
does. Yeah,
But from an SEI standpoint, right? These are assets held within mutual funds or
exactly.
whatnot. So the general uh, concept of what they think it should be usually does apply. That's why I try to get it from them. It's not like it's an individual filing taxes. It's it's on behalf of a mutual fund. But yeah, and also when I say distribution, it could be cash, it could be shares. But then when you talk about cash, the cash distribution could also be a variety of things. It could be income, ordinary dividend, qualified dividend. It could be a return of capital. It could be a long-term gain. It could be a short-term gain. So just because they're giving cash doesn't necessarily mean it is income to the person receiving it or entity receiving it, such as a mutual fund. And some of the asset types that are widely known out there for the different types of classifications of distributions are MLPs, master limited partnerships, as well as REITs, real estate investment trusts.
Why is that? Like from a data perspective, I know that we have to treat those a little differently, but what's the background on that?
Sure, MLPs were created actually quite a few years in like the 80s, and it's mainly focused around the oil and natural gas type industries. Um, they are structured as partnerships, so therefore they are a pass-through entity to the end recipient of the cash distribution. So they are any type of MLP unless it chooses to be taxed as a corporation, which it can. If an MLP is a true partnership, any and all the distributions that you receive in the form of quote unquote dividends are actually a return of capital, which is reducing your cost basis. So if you bought that unit or share of the MLP for $6.50 and they want to distribute you a 50-cent dividend, it actually reduces your cost basis to now it's only $6. So you get that cash for free, you reduce your cost basis, and now your cost basis is only $6, as if you bought it for $6 instead of $6.50.
Yeah.
Um,
There are a few things to be particularly concerned about with MLPs. That was because they're partnership and they do pass through their income. That means any effectively connected income to the U.S., any business income they earn, gets passed on through to the owners. So if you're a non-U.S. person who owns an interest in an MLP who received business income, you may have a requirement to file a tax return. You probably do. A lot of cases people don't, but that's the way the rule is for effectively connected income. It's a very low bar for. It's not like withholding on dividends and interest, where if you get withheld on, as long as you don't owe any tax, you don't have to file anything. If you have business income in the United States, the U.S. expects you to file a return in a lot of cases. So you do have to make sure you keep an eye on that. The other thing is the new rules that are coming down the pipe. 1446F is supposed to come into effect on January 1st of 2023. That's going to add essentially another level of tax where distributions are going to be withheld at 10% unless it can be shown that it's a return of capital. By and large, there are a few exceptions for different things, but it's largely to make sure that what's being paid out by the MLPs, proper withholding is happening for the actual business income that's coming through the funds. Around this time last year, the IRS allowed some transitional relief, and so we may hear again from them this year on that to extend the relief for another year. But as of right now, it's supposed to be in effect as of January 1st, 2023. We'll talk about 871M in a minute, and that one did get some transitional relief earlier in the month.
So why are they having to push that out though? Is it just so that firms can better prepare to make those adjustments when processing? I know we have like from an managed corporate action perspective, where you're introducing a new event type to capture the 1446 distribution with a breakdown of income codes. So I imagine as a recipient, there's some adjustments that need to be made as well. Do you think that that's the primary reason why it was pushed out the first time and potentially a second?
Yeah, I think that generally when the service provides transitional relief, it's to provide the industry a little more time to make sure everything is going to be, all the ducks are in a row. Everything is going to run functionally when it starts on January 1st. No one's looking to have, confusion and inadvertent withholding, because it just ends up making a mess for everyone on the market and the government both. And no one's looking for that. We also expect to get uh, some more guidance out of 1446F to help implement everything. So, but for both those reasons, I think they might extend it.
Because you
All
talk,
right.
yeah, go ahead, Brian.
No, but I was actually just gonna. That kind of explains the MLPs. I was gonna maybe just move on to the other types, which are REITs, which are they
Right.
have their own structure, tax structure that gives them certain benefits and disadvantages as well. A REIT is a real estate investment trust. Well, they are actually a non-tax entity to where they don't pay taxes, but the shareholders that own it do. But in order to do so, they are required to pay out 90% of their taxable income. Um, However, with REITs, when you do get that distribution, let's say 10 cents, a 10-cent distribution from a REIT may not be 10 cents of income. It could be 5 cents of income, 3 cents of return of capital, and 2 cents of long-term gain. Being that it's a REIT, the nature of the business is real estate. So they're either buying and selling actual buildings and homes or investing in mortgage REITs. So, a return of capital will come to play, due to a depreciation expense where they're paying out more than the actual taxable income they receive for that year. Same thing with the long-term gain distribution. They could have sold a few properties that they've held for over a year and then are distributing those proceeds to the shareholders, which then would generate a long-term gain as opposed to income, which is a more favorable tax rate.
Yeah. And to the point earlier, for most people like Brian and many individuals, you'll get treated exactly how they'll report it to you, but it's always right to look and ask and make sure that your specific circumstance allows you to take those income types.
Yes, that's, I think both asset classes have their place within people's portfolios, but obviously it depends on the person and the situation. But from a corporate action standpoint, it definitely poses some challenges, especially because REITs, you're using last year's data to try to, get as close as possible for this year's distributions. So REITs don't announce how much of their total income was ordinary versus qualified versus return of capital versus long-term, short-term gain until roughly February, March of the following year. So for 2022, any REIT you own, you won't know the actual breakdown until roughly February, March of 2023. So basically, we tried to use last year's rates as a guide, and then certain our tax teams here at SEI will do true ups at the end of the year when the new information is available to get it as accurate as possible for the tax returns.
So, Chris, a minute ago, you mentioned 871M. I want to talk about that a little bit because that's been in place, and from what I understand, this is a revision to that based on some distributions slipping through the cracks, like derivatives and other linked instruments that aren't being taxed properly. Can you talk about that a little bit more?
Sure. The basic idea behind 871M is to capture tax on substitute dividends. So um, essentially, it's the piece of gain or loss from a derivative transaction of some type, whether it be an option, a swap, a CFD, some other type of instrument, including convertible debt, where some part of the price of the actual instrument relates to a dividend that got paid. You have to pick up a certain amount of that dividend if you qualify. Right now, and until 2025, under the current transitional relief, That only affects what's called Delta 1 contracts. That would be a derivative contract where the delta between the underlying and the price of the position is 1-to-1. But doesn't mean for every cent that the underlying moves, the derivative contract moves 1 cent. It just means that the effect is the same. So if you have an option, obviously, for example, a 1 cent move is a dollar move in the amount of dividend to expect out of the option because of the multiplier effect there. Same thing if you have a contract for difference or a total return swap of some type, same type of analysis has to get done. And right now, it only applies to those Delta 1 contracts. Once we get to 2025, then you move to 0.8, which brings in a lot more contracts because it doesn't have to move completely in lockstep. It also means you have to maintain your delta calculations. You're supposed to have a delta team similar to a pricing team we may have to identify anything that is or isn't out of scope. This becomes particularly an issue with options because the delta for the options can move as they come in and out of the money, typically only deep in the money. Options are going to have a Delta 1 classification. But where that point is changes depending on the volatility, the underlying, and how many days are left on the option. So you do have to kind of watch those positions.
So that's a good point you brought in. You brought up deep in the money options. I know I've been asked a few times. So doesn't seem to be really any guidance out there. What is considered deep in the money? Is there an actual percent? Is there a dollar figure? What makes it deep in the money versus just in the money?
Yeah, like I said, everyone is supposed to have who basically holds these positions should have a delta pricing team that determines the delta. You can go to a third party like us that'll provide that information for those options, or you can do it yourself. The important thing is to have a standard that you're using, and then it be repeatable and consistently applied. So that way, you have a model that you're using to say, yes, this is how I determine whether or not the delta has gotten to 1. At some point, and it will vary. It's going to vary for everything because the volatility of each underlying is slightly different. And, how likely they are to be in or out of the money, at the time of expiration can change. It also depends what type of option, European versus American style options are going to be much different to determine delta on, because with an American style option, as long as it's in the money, presumably you can exercise it right now.
Why 2025? That seems a long
Well,
time.
Because as people have gotten ready for the 0.8 delta move, they've realized how much work is involved because it is a substantial lift. It will bring into scope a lot more contracts than people, I think, thought at first glance. And the service has realized the industry is making strides to get where they need to get to identify, non-Delta 1 contracts to get to that next level of getting the 0.8 Delta contracts and identify them and calculate the proper dividend equivalent payments that need to be calculated. And it's not a small lift. And I think that's why they provided 2 years. Is they didn't want to give just 1 year of relief. They basically, I think, provided 2 years of saying, this is the last we can expect from them. And so they want the industry to basically make sure they have everything ready to go. So when it does move to 0.8 in 2025, there won't be any disruption. It'll just simply be people flipping switches.
I do have a question. Those delta calcs, is that something that should be done daily, weekly, monthly?
It depends. It depends on who you are. If you're an individual, probably you can do them much more rarely. But yeah, if you're a financial institution, and especially with options, if you're an options broker or dealer, you probably should be doing daily analysis of your options. Some of them can be less frequently looked at simply because the nature of them when they're put on, they're either going to be Delta 1 or they're not going to be Delta 1. And if they're not, because let's say it's a basket swap and there's a mix of different things in it, some of which are equity, some of which are non-equity, doesn't really match any particular underlier, you may get pushed out. To usually the Delta 1 contracts are, very specific, very identifiable. It's a basket of equities. It's a single stock equity. It's an option on an ETF that's not qualified. Then, those are clearly going to be in scope because it's one-to-one. That's part of the reason too, is the Delta 1 contracts generally are pretty easy to spot. Once you move away from Delta 1, it becomes much more of a slippery slope.
And the Delta ones is definitely more on, I'd say, the tax side than it would be the corporate action side. Because on the corporate action side, basically, we would issue the options and exercise them if need be, but then the calcs and then the withholding tax would definitely be more on the tax side.
Yeah, and that's for example, when we work with the corporate action teams because we're able to look into the underliers and say, hey, there's an event at your underlier, you have to, accrue a substitute dividend for the payment, and because we're able to look to the underliers, we can do it for indexes and much more complicated transactions than most people are able to do by themselves.
Okay, so we've been talking about derivatives, options, equities. What about debt?
Yeah, debt comes into play too, especially in a very direct way under 305. Well, 871M typically doesn't cover debt instruments unless they're convertible debt instruments. 305C will cover issues where you have price changes that are keyed towards underlying dividends, and the service wants to make sure you're picking up the dividend equivalent essentially on those pieces as well from any changes in the conversion prices of the underlying debt.
Yeah, so that would play two factors. One, it affects tax, but two, it also affects corporate actions and SecMaster. So again, if you had a convertible bond of Bank of America and the bond is convertible at a rate of 22.5 shares of the equity, if Bank of America pays a dividend, it lowers the price. So therefore, your conversion rate may go to 22.6. So that 0.1 basically is considered income to the convertible bond holder that you have to account for. So in the setup of that convertible bond security, you have to update the conversion rate, and then two, on the tax side, you have to factor in that dividend equivalent.
Yeah, and we can, and obviously we help people with those calculations because it's a lot to keep track of, and it's not always obvious because you're not seeing a cash payment anywhere there.
That was going to be my next question. You just kind of described in my mind something a little bit complex, Brian, so it seems like a lot to keep up with.
There is, and the same thing with bonds. Not only do you have to keep this in mind, but bonds also are able to be exchanged for other bonds, especially depending on the interest rate environment, which we're dealing with now, right? We're in an environment of ever increasing interest rates. So a lot of times companies will put exchange offers out there, and just because, again, there's no cash received, you're just exchanging this bond for this bond. That doesn't mean you're off scot-free. The bond may fall into what's known as a significant modification, there's about 5 or 6 tests you have to do to see if your exchange falls into any of those categories.
Yeah, and if it falls under a material modification, then you have a new instrument for tax purposes. You have to essentially take your gain or loss on the original position and then figure out what your cost is on the new position. And it's not always obvious.
It is not. And, just because you pass 1 or 2 tests doesn't mean that, the fourth one out there didn't trigger the tax. So just real briefly, you have, there's 6 of them out there, but you have a general test, the facts and circumstances of the exchange. You have a change in yield. You have a change in timing of payments. You have a change in the obligator of the bond, change in the nature of the debt, and any change in important covenants of said debt. So you have to go through all of those to see if you are going to get caught up in a tax situation.
Yeah, changing your debt covenants is one of the ones that people miss often. Sometimes because it's one of those areas where sometimes they'll make an adjustment to debt covenant that's relatively minor. They'll make a payment to it. That payment probably is going to be taxable. It might be in the nature of interest. It might be a fee of another type, but the payment itself might be taxable, but it may not trigger a taxable event for the entire position. Sometimes it does.
Yeah, that's definitely not an obvious one. I'd say two of the very obvious ones would be timing of the payments. So if you went from a semi-annual that pays, every June and December to an annual that pays every October, obviously your timing and payments has changed and could trigger the taxable. Same with yield. The yield test is the greater of 1/4 of 1% or 25 basis points, or 5% of the annual yield of the unmodified instrument. So those two calcs are pretty simple and obvious to someone looking at it just on its face. If you had a 5% bond now paying 7 or 8%, that calculation is easy to see if that triggers the yield change modification.
And some may not be. In some instances where it's not a taxable transaction, may be harder to spot too. Like name changes don't necessarily mean it's going to be taxable.
Even a QSIP change for that matter, going
Exactly.
from a 140 a Reg 144A to a non, that it will change QSIP, but that's not a taxable event.
Right. Exactly.
Well,
So,
y'all, I have learned so much today. I feel like the two of you could go on for another hour with everything. But thank y'all so much for joining today and helping us plan for the future. Really appreciate your participation.
Thank you for having us.
thank you very much.
To our Golden Record listeners, what should we talk about next? Write to us at goldenrecord@spglobal.com with your suggestions. More to come soon. Keep listening.